Anastasia, great to see you this morning. Why don't you explain first why you think we're not in a bubble right now? What tells you that?
Yeah, good to see you, Becky. And you're right, this is one of the most frequent questions we get these days. The biggest answer to that is, first of all, it is not the classic definition, that we don't have the classic definition of a bubble, where you have the price action that's disconnected from fundamentals. If you look at earnings today for this year, we're looking at $178 on S&P. And if you assign a 22 times multiple to that, you're just about where we are today. Now, where does the upside come from? I think the upside comes from future earnings revisions. And as we get to that herd immunity, we think 70% vaccinations by September, you are going to get some upside to those earnings. So I think the markets are fairly priced. The other biggest condition, I would say, that is missing to call this a bubble and valuations that are not sustainable, something has to pop those valuations. And typically that something is higher interest rates. Well, we do not see that for the foreseeable future. And in fact, probably the most frequent question I actually get is this 1999? Well, in 1999, the Fed funds rate was at 6.5%. It is at 0 today. In 1999, the spread between the earnings yield and the bond yield was actually negative. Today is positive 3.6%. So, Becky, that's why any chance investors get to buy into this market on a 2, 3, or 5% pullback, that's why the money just keeps on going into the equities market.
I take it the comments you heard from Jay Powell yesterday reinforced that idea, the idea that the Fed's going to be keeping this accommodative policy, these low rates for a long time to come.
Yeah, that's right. And we know this has been the Fed policy for a while as they made that pivot to look at average inflation versus, realized in any given month. And even if we have a transitory spike in inflation this spring, which we do expect, this is not going to change the trajectory of the Fed. The Fed is on hold probably till at least 2023. So this very supportive negative yield environment and this positive spread between earnings yield and bond yield, this is what we've had for the bulk of the last 10 years. And as you can tell, this has significantly supported those equity valuations. So I will say there's things that we have to watch in the markets for speculative activity, and you covered them very well on the show. And there are pockets of maybe a little bit of frothiness. We have seen trading, for example, in negative EBITDA companies that has spiked to 16% of trading volume, so back to where we saw in 1999. We saw trading in high multiple growth companies that is also significantly higher. So there's definitely pockets to watch and be cautious. And by the way, many investors have made a lot of profits in those names over the last year. So it is prudent to take a little bit off the table in some of those names. But even if the market broadly may look a little bit expensive, we still see pockets of opportunity that are not at all expensive.
We'll talk about those in just a second, but just to be clear, if somebody's invested in the market, you wouldn't tell them to sell here. You would just say wait for a pullback, whether that's 2, 3, 5%, whatever it may be, before they put additional funds to work?
I don't think this is the time to broadly reduce equity exposure. I do think it's the time to think about repositioning some of the exposure. I'll just use tech as an example. Some of the software names have done exceptionally well for us, and I wouldn't be opposed to taking a little bit off the table in some of those high multiple names and repositioning it to the more industrial geared, manufacturing geared part of technology, some of the semiconductor names, for example. So that would be the broader recommendation. Definitely not reducing broad equity exposure. I do think that short term, we probably are a little bit extended, and hedge funds that maybe degrossed a little bit a couple of weeks ago, they've added to those positions. And, we've run a long way in a short period of time. So you could very easily get a 5% pullback if a catalyst comes along. It is normal. It's what we expect, a 5% pullback every quarter. And if you do get it, I think that's when it's important to have the shopping list of things ready that you do want to buy at that moment. Because as I've seen, Becky, those 5% pullbacks did not last long in this market environment.
Shepard Smith here. Thanks for watching CNBC on YouTube.